You now only need a 2% deposit to buy a place in South Australia. This video will cover what this means, why it's important, and how this or any other policy is not going to mean that the Australian property market will crumble. Higher interest rates will not mean that Australian property market by and large will collapse due to mortgage defaults. If any of these things are interesting to you, carry on watching. My name is PK and I help people build passive income through property investing using the Property Investment Accelerator through data without needing a $15,000 buyer's agent every single time. And in this channel, we discuss property investing, the economy, and financial happiness. Subscribe now. Let's go. So you can see here that this is from the Premier of South Australia's government website. 2% home deposit opens the door for more South Australians to buy their own home in a state first. This is a brand new policy by HomeStart. So more South Australians will be able to get into their houses sooner after state government-backed lender HomeStart Finance dropped the minimum deposit required for its graduate loan to just 2%. Okay, this is the first time that they've actually done this, and it could actually wipe out literally tens of thousands of dollars of your deposit. You don't need that anymore or as much to get into South Australia right now. So for example, let's say you're buying a place of $400,000 and previously you needed, this is just saying 3%, you actually now only need a 2% deposit. That's only $8,000, okay? So let's say you previously needed a 20% deposit to avoid lender's mortgage insurance. You know, you would have needed to $50,000, you probably needed $60,000 to cover the deposit in order to avoid lender's mortgage insurance. And that's the great thing. This 2% deposit scheme, you still don't need to pay lender's mortgage insurance. For those of you who don't know, lender's mortgage insurance means that if you're putting down less than 20% deposit, you need to add on like $5,000, $6,000, $7,000 to the bank, right? That's what you need to pay for the luxury of putting down just 2% deposit or 5%, 10% deposit. But in this scheme, because it's state-backed, you don't actually need to pay that. So this is a completely, unrivaled and revolutionary policy. And unlike many commercial lenders, like I've just said, HomeStart does not require lender's mortgage insurance. And, they're saying that this could have been in excess of $10,000. So this is really something revolutionary for the South Australian property market. Thousands of South Australians are saving hard, and this could mean the difference between them buying a home versus not buying a home. Now, here's the thing. The graduate loan is available to South Australian residents with a Cert 3, 4 diploma, bachelor degree, or higher qualification. So effectively what the bank is saying, what the lender is saying is you guys are more reliable, you have some qualifications, therefore you don't need to put down that much deposit. The graduate loan is available in metro areas and regional areas, so everywhere in South Australia, right? And with the home required to be bought or built as the purchaser's primary residence. And that's really what has driven the current property boom in South Australia. It's not so much investors, although they're creeping in now. For the last 2 years, it's been primarily driven by home buyers, people to live in their own home, upgraders or first home buyers. Although it's not the biggest policy in terms of numbers, this is going to be additional firewood underneath the boom that South Australia, especially Adelaide, is facing in its property market. Everyone knows Sydney, Melbourne is going down, Brisbane property market started to go down, but the complete opposite is true for Adelaide. In fact, it's the hottest property market right now, still growing at double-digit levels, for 2022. So if you're an investor, of course, you can't access this. You have to be live in the house for you to access this, but this affects the property market that you're looking to buy in. And so I think that area, the South Australia or specific parts of Adelaide, will continue to go up. There's no cap. You can buy a $2 million property, a $200,000 property. There's no cap on this one. Now, I know what many of you are thinking. You're thinking, well, here's another policy that further destabilizes our banking system. Now, all these people aren't going to be able to afford their mortgages when interest rates go up, and it's going to create an even bigger property market crash. I know many of you guys think like that. And here's a chart that kind of illustrates the reality of the foreclosures of the default market in Australia. So APRA, the Australian Prudential Regulatory Authority, past due loans as a percentage of advances. This is basically a good measure to say how many foreclosures or how many times are people mortgage holders in Australia back or delayed or not able to make their mortgage repayments. And obviously the data isn't, super recent, but you can see that this has just come down and down and down and down. This is where it was in the global financial crisis. So interest rates will go up, or they are going up, and I fully expect this blue line to come up. But it is off a record low at the moment. It is continuing to go down at this stage. And even if it goes up to sort of half of GFC levels or even GFC levels, everyone forgets that even in the GFC, Australian property market only came down by about 8%. And even during the GFC, there were property markets that continued to go up, particular cities, particular towns that continued to go up. And after the GFC, we know what happened, right? So I just want to demystify it and always remember, right? If you're with me so far, this is the crux of it. So well done. Last year, at the lowest rate of interest rates that were available in Australian history, let's say you refinanced or you got a loan for 1.89%. All right. So everyone says, oh, look, they were so low and now interest rates are so much higher. They're going to become higher. All these people not going to be making their mortgage repayments. All these people are going to have to sell their houses, especially investors. Like that's the theory, right? People invested in a bubble. Now that bubble is popping. But just keep in mind that 1.89 standard variable rate that investors got sort of mid to late last year, that was given with a few caveats from the banks to insulate themselves and insulate the borrower. The first thing that banks do is they say, we're going to assess your ability to repay that loan on 3% higher interest rates. So not 1.89, but 4.89. And so interest rates have to rise by 3% for in the bank's calculation for mortgage owners or mortgage holders to be stressed. That's not happening anytime soon, but there's more. Then what the bank further does is they say, look, you make an income PAYG, brilliant, we shave it in the calculations to give you that loan at 1.89 originally. Furthermore, the rent that you get, because obviously it's investment property, the rent that you get, we're going to shave that. We're going to assume that you only get 70 to 80% of the rent that you're actually getting from that investment property. So furthermore, the bank is insulating itself and the borrower against default and more. They add to your expenses. So let's say your household budget is making this up right now. The household budget for you is $2,000, right, per month, right? Or let's say $3,000 per month. The bank, when it assesses you, it's been taking $4,000 or it's been taking $5,000. So it's saying that, okay, your expenses as per your credit cards, as per what you've shown, as per your bank account statement is showing this, we're going to put some extra buffer in just in case. That's what Australian banks have been doing for years and years and years. This is why the Australian banking system is so strong. And so what that ultimately means is that even though people got an interest rate at 1.89%, and all the doomsdayers will say, oh, look, interest rates are going up, these people can't afford them, they're going to be defaulting, properties are going to come on the market, they're going to crash. The reality is that 1.89%, after accounting for the shaved income, after accounting for the 3% extra interest rate buffer, after accounting for the inflated expenses in the calculation of banks when they figure out exactly how much they can borrow, after accounting for all that 1.89% is actually more like 5.5 to 6%. So people who got that loan of 1.89%, the banks actually calculated it as if, almost indirectly, implicitly, that they were paying 6%. All right, and interest rates aren't going up to 6%. And then obviously they'll come down. Right now, the thinking is interest rates might go up another 1%, at which point they'll stabilize, they'll come down. So nowhere near that sort of 6% mark for the average standard variable loan rate. So, these policies that I talked about at the start, the 2% deposit, no LMI by HomeStart in South Australia, there are a lot of people who will say that, oh, look, that's just making our banking system more fragile. It's actually not the case if you understand it in context and with data. This is a great policy, and it will get so many more people into the property market in South Australia, those people who couldn't afford it otherwise, that have just started their working careers, that have qualified, and that will just boost the housing market in South Australia. Great place to have owned a home, or great place to own a home right now. For you investors, you know what I'm talking about. All right, guys, hopefully that was useful. Smash the subscribe button, give it a thumbs up. I want to just bring you more and more of this type of value, unbiased content. If you want to level up your knowledge, leave a link below to my Facebook group, more than 20,000 people. That actually was one of the members who sent me this video, so big shout out to you. And also my podcast on Google, Apple Podcasts, and Spotify. I really learned this stuff. You know, you can still buy fantastic investment properties right now. I'm not just saying that like that's the truth. I'm investing right now as well. And a few videos from now, I'll actually share with you the properties that I'm looking at and what type of deal I'm about to strike. All right, guys, my name's PK. I'll catch you next time. Bye.